Hi, hi, and welcome everyone. My name is Afrona, and on behalf of the Esgian Rig team, I would like to thank you for attending our end of year webinar. Joining me today are Matthew, Nermina, and Sophia, who will share valuable insights reflecting on this year that we are leaving behind and provide a forecast for 2025. On an important note, the data presented today is sourced from our market intelligence platform, Rig Analytics, which monitors the entire offshore drilling fleet, and Rig Values, our independent rig valuation platform. Towards the end of this webinar, we will have our Q&A session. I encourage you to write down any questions you might have in the Q&A chat box. We will address them during the session, or if time does not permit, we will follow up with you privately. Without further ado, please enjoy the webinar. Matthew, over to you.
Thank you very much, Afrona, and thank you to everybody for joining us here today for plotting a course, an offshore rig market review and forecast. My name is Matthew Donovan, and I'm the head of the rig research for Esgian. Looking at our agenda today, we'll be reviewing the 2024 offshore rig market for floating rigs and jackups. We will then take a special look at the North Sea going forward before moving on to offshore rig values. Turning now to the floating rig market in 2024. Over this year, we've seen availability grown in the floating rig market. Floating rig market remained strong for much of 2024, with rigs continuing to secure contracts with high day rates during the first half of the year. However, the pace of rig contracting has slowed as expected demand was pushed forward. We're now seeing floating rigs coming off contract in 2024, particularly benign semi-submersibles and sixth-generation drill ships that have struggled to secure new jobs for the year and are facing idle time reaching into 2025. Now, our competitive utilization for drill ships this year peaked at 80% in August, and since then has hovered at around 74 to 76%. While competitive utilization for semi-submersibles was at 69% in August 2024, declining to 62% in December to date. Looking at the market over the year, we have seen the Golden Triangle remain the focus of work for deep water floaters, including the US Gulf of Mexico, West Africa, and South America, with South America bringing the most potential for growth in the regions. 2024 also saw the latest major consolidation in the floating rig market as Noble acquired Diamond Offshore, becoming the contractor with the largest floating rig fleet. Another change in the market: by the end of the year, we expect a total of 4 drill ships to have entered the fleet, although 2 of these have yet to find work, so adding to the number of available units globally. Now, looking ahead for our floating rig demand forecast, we expect demand to soften for floating rigs over the first half of 2025. Drillship demand globally is expected to dip from late 2024 into the first half of 2025 as rigs continue to roll off contract and new fixtures for activity in 2025 remain low. And what we've seen recently is that basically demand for floating rigs has been pushed into the future, projects moving into 2026 and beyond. This has been a variety of different factors involved with this, including capital discipline from operators in the face of cost overruns, extended negotiation times for long-term and complex rig contracts, and supply chain bottlenecks for non-rig related equipment. Right now, we're seeing multiple contracts that are under negotiation that begin over a year into the future, and these are tending to be long-term contracts, at least over 2 years. So what we might see is the supply in the rig market tighten up as those contracts are fixed. But since most of this work is for 2026, 2027, and beyond, we are seeing 2025 with some declining activity. Short-term demand for much of 2025 is uncertain. Drilling contractors are preparing for idle time for available units to continue, although we have seen interest from some smaller operators to take advantage of the near-term availability and drill short programs, particularly with activity in West Africa. As I mentioned earlier, demand for drill ships will remain focused in the Golden Triangle. Sort of towards the end of 2025 and into 2026, we are expecting to see some demand rise for South America and West Africa, which will continue over the next few years, while the US Gulf of Mexico is expected to remain flat through 2026. Semi-submersible demand is expected to remain flat from late 2024 through the first half of 2025, with some slight strengthening expected after the dip in due to planned activity in South America, the North Sea, and the Mediterranean. Additionally, contributing to the demand for semi-submersibles, the Far East market, which is largely self-contained, although we are seeing some units here making their way into the South American market going forward. The harsh environment semi-submersible market remains clustered in the North Sea, with contributions from Australia, certain parts of Africa, and occasionally Canada. And we've seen an increase in semi-submersible demand in Norway recently, which is leading units to move back into the region after they left for work in Africa and Australia in 2023. Turning to floating rig day rate forecast, we are expecting day rates to trend downwards from 2024 into 2025. With high utilization in the market, floating rig day rates increased into early 2024, and we saw 6th and 7th generation drillships securing day rates above 500,000 this year. However, with the slowdown in contracting and that increased availability for 2025, the market has become much more competitive, and day rates for new drillship fixtures in the market are now being discussed in the mid 300,000s to low 400,000s. In addition to that, we've seen 6th generation international semi-submersible rates continue to lag below drill ships due to the continued availability in that market and operator preference for drill ships globally. So we're expecting clean day rates for new fixtures in the market to trend downwards from late 2024 into the first half of 2025, flattening out towards the end of the year as availability is slightly reduced going into 2026 as new contracts begin. Looking to harsh environment semi-submersibles, we're expecting day rates for those to hold steadier than day rates in the benign market due to the restricted supply of rigs suitable for activity in the North Sea and other harsh environment areas. Turning now to the jackup markets in 2024, there was a marked downward trend in the market stemming from Saudi Aramco's contract suspensions. Global jackup demand and utilization weakened over 2024 due to Saudi Aramco's 3 rounds of contract suspensions. Now, we've seen the strength in the jackup market in recent years increase as a direct result of increased contracting from state oil companies in the Middle East, particularly Saudi Aramco. So we're now seeing increased availability in the market as Saudi Aramco has been putting units on suspension. Competitive utilization in the jackup market remains high, but market uncertainty from the suspensions has had global effects, including the cancellation or postponement of ongoing tenders in other regions as operators anticipate an increase in rig availability. We have seen increased interest, though, in jackup activity in West Africa and Southeast Asia, as smaller operators have sought to take advantage of a lull in global demand to secure rigs for short-term projects, although we have seen some multi-year ones fixed recently. We're looking at older and lower spec units for the Middle East. Some of these are likely to have difficulty in securing work in other markets due to their capabilities and general operator preference for newer and higher spec units spreading globally, even in markets that have traditionally taken lower spec jackups. We'll now move to a particular focus on contract suspensions in Saudi Arabia, as this has been the major driver in changes in the jackup market this year. 32 jackups have had their contracts suspended with Saudi Aramco so far. So after sharply increasing its contracted rig count in recent years, Aramco began cutting back earlier this year after it was via contract suspensions after a January 2024 directive to keep the maximum sustainable capacity at 12 million barrels per day, reversing a previously directed increase towards 13 million barrels. So those discussions over contract suspensions began late in the Q1 of 2024. That first round resulted in 2022 contract suspensions. We saw a second round of suspension start in July 2024, with another 5 placed on suspension. A third round began in November 2024, with 5 jackups known to have been suspended so far. We've seen the number of rigs drilling in Saudi Arabia fall from 88 units in early 2024 to just below 60 units in early December 2024. Now, these contract suspensions are up for up to 12 months. And the original term of the suspended contract is to be automatically extended for a period equal to the suspension for each rig. Contractors can market rigs for additional work during their suspension, and so far we've seen 9 suspended units known to have secured work with other operators during the suspension period. And as a result of this, we have seen a number of units that have terminated their contract rather than remaining suspended with work for Saudi Aramco in the future. We're expecting further suspensions or contract terminations are possible. In addition, Aramco is understood to be considering letting rigs roll off contract in late 2024 through early 2025 without renewal. However, Arrow Drilling, which manages 5 of these units, has stated that it is in discussion with Aramco about some potential new contracts. We may also see day rate renegotiations under consideration for jackups remaining under contract with Aramco. We've got approximately 10 units rolling off contract by around the end of 2025. For the jackup demand forecast, up the 2024 decline, global jackup demand is expected to remain flat over 2025. We've seen competitive utilization in the low 80s. Demand will continue to be affected by the continuing suspension of contracts in Saudi Arabia. The global demand in general, again, being pushed from 2025 to 2026 and beyond due to long lead times and bottlenecks, unnecessary equipment, and again, capital discipline from operators. The projects are facing cost overruns or elevated day rates. Also affecting the global demand, there's been payment issues from Mexican state oil company Pemex, has led to some short-term suspensions of jackups in Mexico, reaching into early 2025. Looking worldwide, we have seen suspended jackups secure contracts elsewhere, including Southeast Asia, West Africa, and South America, but the global market is only slowly absorbing this excess capacity. And while the Middle East remains the largest market for jackups, forecast demand in the region is not projected to return to previous heights over the next 2 years. With Saudi Aramco unlikely to hire many new rigs over the next 2 years, there are still other operators in the region looking for jackups, including Qatar Energy, Kuwait Oil Company, Al Khafji Joint Operations, Bunduk, and SNOC. For our jackup day rate forecast, the uncertainty in the jackup market largely halted forward momentum on jackup day rates in the second half of 2024. We saw some new fixtures for premium jackups earlier in the year remain around previous levels during the early stages of contract suspension, but as those have continued and new rigs have entered the market looking for work, we've seen several new fixtures at lower rates, and fixtures for standard jackups have been recorded well below previous ranges as the contractors seek to secure market share in the face of heightened availability. We've seen recent fixtures for premium jackups in the low to mid 100,000s, while some recent fixtures for vintage and standard jackups have been in the 80,000s and below. We're expecting those rates to continue to decline from late 2024 into 2025, then flatten out due to the greater global availability of jackups and the remaining uncertainty in the market and limited demand. However, we can look, while 2025 may be difficult, we can look at a brighter outlook ahead for offshore drilling as the overall outlook for rig demand improves beyond 2025. While the forecast supercycle for offshore rigs looks less positive than it did in early 2024, the outlook for offshore rigs is still strong in the longer term. In general, what we've seen is demand for rigs move forward rather than disappearing entirely, drilling start dates moving into 2026 or beyond rather than being entirely cancelled. Capital discipline in the market in recent years has ensured that many recently sanctioned development projects have relatively low break-even points and will remain profitable if commodity prices trend downwards. So after a slow 2025, we are expecting floating rig demand to start to trend upwards into late 2027, while jackup demand remains stable following the 2024 dip. And it is important to remember that even with an increase in renewable energy resources, the world will continue to need fossil fuels over the next 2 decades, ensuring a continued market for offshore drilling as we go forward. Another positive side effect for the market is that rig supply will remain constrained. We've seen very few new rig orders expected over the next several years due to the high costs, long lead times, and limited yard availability. And there are few remaining new build floating rigs and jackups left in yards at this time. Drilling contractors have proved themselves willing to cold stack or retire rigs during periods of downturn. So we can expect some supply balance in the market going forward. With that, a period of flatness, rig day rates are forecast to begin improving in most categories by late 2026 and beyond as excess capacity is reduced and demand strengthens. Operator preferences for seventh generation drillships and premium jackups will result in more noticeable day rate increases for those units. We will turn now to the offshore rig market in the North Sea with our analyst, Namina Kulovic. Thank you, Namina.
Thanks, Matthew. Hello, everyone, and thanks for joining us today. My name is Nermina, and I'll walk you through key developments in the North Sea over the past year and share insights on what to expect in the year ahead. So let's dive right in. One of the most prominent trends in the North Sea in recent years has been the reduction in rig count due to soft demand in the region. Along with departures to other regions, a notable number of units have been scrapped, including 3 this year. However, 2024 also saw a few rigs added to the North Sea supply, including one arriving from China to Norway and another returning from Canada to Norway, where it's currently awaiting its next opportunity. In addition, a semi-sub that's been operating in Africa over the last couple of years is set to return to Norway for a long-term contract starting in 2025. This significant decline in overall rig supply is evident in the first chart on the right, which highlights the reduction in overall rig availability. Currently, the North Sea region, excluding Russia North, holds a total of 55 rigs, which is down from 64 at the end of 2020. While overall supply has declined, the number of rigs working has been steadily rising since 2022, indicating improved utilization. Additionally, the number of available warm stack rigs has decreased, leaving the market with fewer ready-to-deploy units. Similarly, the number of cold stack units has dropped significantly compared to 2020, reflecting reduced long-term inactivity in the fleet. Notably, one cold stack semi-sub in the UK is up for sale, and 2 stacked semi-subs in Norway are still being marketed for new opportunities in the North Sea and beyond. Turning to the second chart on the right, which highlights utilization, we can see that 2024 levels remain consistently higher than in 2023, with a decline towards the end of the year reflecting the cyclical nature of the industry. Next slide, please. In 2024, the sluggish pace of awards contributed around 26 years of backlog in the North Sea, about half the volume recorded in the previous year. Notably, over 600 days of UK backlog initially planned for 25 were deferred following the lapse of a previously announced letter of intent and the termination of an awarded contract in late 24. Jackup units were the primary contributors, while semi-subs lagged behind, reversing the prior year trend in which semi-subs had driven the majority of new awards. Focusing on 2 major contributors in the region, the UK and Norway added a comparable number of backlog years in 23, but in 24, Norway's contribution was significantly smaller. Next slide, please. Overall, Norwegian demand was essentially flat in 24, but it's projected to rise towards second half of 25. Looking at segments, the Jackup fleet in Norway remained stable in 24 with minimal backlog added. However, the entire fleet is already booked through 25 and half of the fleet is also committed for several years beyond. In the semi-sub segment, a number of extensions were secured throughout the year and a new long-term contract with the potential for 7 years of backlog was recently confirmed. The fleet has good contract coverage through 25, with new lines of inquiry emerging for work in 26 and beyond. Several sublet agreements are expected in the coming years due to tight supply. Over in the UK, demand growth in the Jackup segment was offset by a decline in the semi-sub segment, resulting in only a slight overall increase in demand in mid-24 compared to 23. Demand in the semi-sub segment was struggling, adding very little backlog during the year, most of it in late 24. As a result, less than half of the active semi-sub fleet is firm through 25, and the remaining contracted units could become available during the year unless their existing options are exercised. There's also the possibility of more units leaving the country. Meanwhile, with the majority of new awards in 24 going to Jackup units, the Jackup fleet is expected to remain strong for much of 25. The existing backlog, combined with government support for new energy projects and the drive to complete outstanding P&A projects, suggests a brighter outlook for this segment. Several new long-term opportunities are available in late 25. Looking ahead, despite the EPL rate increase and its extension, the government's autumn budget announcement at least provided much-needed clarity and certainty to operators. And finally, this year's tie-ups between Eni and Ithaca and Shell and Equinor could provide the momentum needed to help extend the life of the aging UK basin. Overall, with supply and demand in the North Sea in tight balance, there is limited room for growth in the near term. In this constrained market, the limited availability of rigs has kept the remaining units active, but meaningful growth would require a significant shift in demand or additional supply. That's it from the North Sea. Thanks for listening. Next up is Sofia with offshore rig values.
Thank you, Nermina. Hi, everyone. I'm Sofia Forestieri, and I'll be covering the rig values portion of this webinar, where we will have a review of 24, going over the market trends and the challenges, as well as a look ahead with short-term and long-term forecasts. Next slide, please. Okay, so we're going to start by looking at how offshore rig values have developed in 2024. Matt, can you go back one slide, please? Yes, so first things first, rig values, they are directly affected by rig demand, day rates, and rig utilization. So as we have seen in detail throughout this presentation with Matthew and Romina, the jackup market has been significantly affected by the suspensions, whereas the harsh environment and the deep water segments, they have showed more resilience. Now, when it comes to the premium jackups, we have seen values being lowered throughout the year. And that is mostly due to the jackup at the Aramco and the Pemex suspensions. So the first adjustment started back in April, right around the time of the first round of suspensions, where the values averaged around 100 million. Then in November, values were further reduced by 10%, averaging around 90 million. And that was due to 2 more rounds of suspensions from Aramco, as well as the recently announced Pemex suspensions. Now, when we move to the chart to the right and we look at the Norwegian compliant harsh environment jackups, we see that they have averaged in 2024 around 205 million. And we attribute this resilience to those values to the high specification and the uniqueness that this Norwegian compliant rigs have. Now, moving below to the floater market, what we have seen in 24 is that the drill ships, they were less affected by this softening in the market compared to the 6th-gen semis. When we look at the 7th-gen drill ships, they average around 364 million in 2024, while the 6th-gen drill ships, they were adjusted slightly down throughout the year, and they were averaging around 220 million. And this also resilience in drill ship values, it is attributed to a continued focus that the market has seen in high spec and deep water operations, as well as a growing demand for advanced units. Now moving to the right, starting with the Norwegian compliant harsh environment semis, they have remained stable throughout the year. And when we look at the 6th-gen international semi values, we see that the story is completely different. They have been revised down
throughout the year, and that is due to a slowdown in fixtures as well as lower day rates when compared to previous years. Next slide, please. Right. When it comes to rig sales, what we saw in 24 was a recovery in the number of transactions compared to 2023. However, we saw that the number of Jackup transactions actually hit its lowest point since 2018. And when we look at the overall list of sales that have happened this year, one interesting highlight is that we have only seen sale for recycling in the semi-submersible segment. Next slide, please. Now looking at offshore rig values, short-term and long-term forecasts. What we have seen in this webinar is there are several developments in 2024, and we do expect those developments to impact the next couple of years in terms of rig values. When we look at the bottom left corner and we start with the premium Jackup average value forecast, we expect that values will continue to decline already starting in early 2025 and to slowly start picking up and rising by the second quarter of 26. We do expect those values to peak by 2028. And when looking in the long term, following this 2028 peak, values are expected to gradually decline until 2035, and that would mark the end of the cycle. Now, when we look above in the harsh environment segment, what we expect is for both semis and jackups for values to be neutral in 2025, starting to pick up in 2026. For both rig types, we do expect values to peak in 28, and in the long term, we expect rig values to decline less steeply when compared to the premium jackups, and that is sustained by the tight supply in the North Sea that we have seen in Ermina's presentation. Next slide, please. Now, here when it comes to the deep water segment, again, the drill ships in the forecast are expected to be less affected by this short-term weakness in the market compared to the 6th-gen semis. So for 7th-gen drill ships, they are anticipated to remain stable in the next couple of years. Whereas when we look at the 6th-gen drill ships, we expect the value to decline through 25 and start to recover by 26. Again, the focus on high spec and deep water operations is expected to persist in the long term, and then that will help sustain the values, especially for the 7th-gen drill ships. And we do see values peaking in 28, and then in the long term, as mentioned, slightly declining. Now, the 6th-gen international semis will be more affected. As mentioned, we do expect values to decline in 2025 and only start to recover through towards the second quarter of 26. We expect them also to peak in 28 and in the long term to decline more compared to the drill ships. And that is also due to the factor that there is a operator preference for drill ships compared to the semis, especially in deep water operations. Next slide, please. And here we get to our Esgian rig market predictions for 2025. We have a list of 6 predictions that we believe are most likely to happen in 2025. And we start with the floating rigs and jackups that have not yet secured work for 25. They're likely to be idle for a significant portion of the coming year as rig demand has been pushed forward into 26 and beyond. Also, additional availability in the market will lead to increased cold stacking and retirement in both the floating and jackup market. Also, when it comes to day rates for both floating rigs and jackups, they're expected to undergo some periods of flat or weakening rates compared to 2025 due to the highly competitive market. Now, when it comes to rig values, our first prediction is major merger activity. There could be the first major merger between two of the big four contractors. Example, Transocean, Valaris, Noble, Seadrill. Also, the number of premium jackup rigs held for sale is expected to significantly increase compared to 24 levels, and we would see a priority for recycling of older units and the sale of idle and cold stacked units. And finally, drillship values, they will be less affected in 2025 compared to jackups and 6th-gen international semis, with 7th-gen drillships remaining stable and 6th-gen is slightly decreasing. With that, I end my presentation and I hand it over back to you, Afrona. Thank you.
Thank you, everyone. Thank you, Tim, for this interesting session. We had few seconds problems with the internet connections somewhere in the middle of the webinar. We apologize about that. Please rest assured that we will be sharing the presentation slides and the webinar link recording with you after the webinar. Now we have reached our time limit, but I would like anyway, we have some questions. Maybe let's take one of them. One of the question is, what short-term opportunities or challenges do shipyards need to navigate in 2025 based on this forecast?
Hi, Frona. Thanks for that question, everyone. So I think obviously with shipyards, a lot of shipyards are actually quite busy with work that's not maybe building rigs, but building sort of FPSOs, other related equipment, oil field services equipment. And I think one thing that we will see probably in 2025 is a lot of companies tend to take advantage of any periods of idle activity to have rigs go through SPS certification, upgrades, repairs, things like that. So, I think 2025 would be a good opportunity for shipyards involved in that aspect of the industry. Probably be an increased demand for rig docking in that respect. And in a longer term, I think with very few rigs being built, companies are also drilling contractors are interested in what they can do to upgrade their rigs or keep them working, longer term. Rather than retire them, if at all possible.
Thank you, Matthew. I hope that was clear. Maybe I can have one more question before we exceed the time limit.
Mm-hmm.
So now that we are seeing the modern efficiency of drill ships improving with the time spent per well decreasing, do you foresee this potentially softening the expected upturn in 2026? Could this also widen the gap between modern and older rigs?
That's a great question. And I think that's something we've seen in recent years is that, rigs do tend to drill more quickly now. They're more efficiently built. And we've got a relatively youthful fleet when it comes to floating rigs. So that's something that's kind of already taking effect into the market going forward. And we've seen a definite operator preference in general, especially in the floating market for newer, higher spec units. Particularly, we're seeing, increased interest in projects like managed pressure drilling, upgrades like that. So that's a definite widening in the market there and probably will contribute to some of the idle time for lower spec units as we go forward.
Okay. Thank you, Matthew, very much. Thank you, the team. Thank you all the attendees for being here with us today. We will come back to the rest of the questions to you privately. We'll reach out as well with the slides of the presentation and the recording link. Thank you very much and have an amazing holiday season.
Thank you, everybody.
Everybody.
Thank you, everybody.
Bye.
Appreciate you.
Bye.
Thank you.
Bye.
Bye.
Bye.